Investor sentiment getting a boost after a Wall Street Journal report over the weekend pointing to consensus among Fed officials to hold rates at next week's meeting. Here to break it all down, we want to bring in Hugh Roberts, Quant Insight's head of analytics. Hugh, it's good to see you. So certainly some optimism, some boost here in investor sentiment, at least for today. A lot of that on the back of the gains that we're seeing in tech. How do you see this, or how do you see the market set up heading into inflation print on Wednesday morning?
Well, I think inflation has become almost more important than payrolls over the last year or so. It's been the high frequency data point for markets to watch. And I don't think it's an overstatement to say that this particular month will probably be one of the most important. Don't want to be flippant, but the declines that we saw, from 9 down to kind of 3 over the first half of this year was kind of the low hanging fruit with base effects. Those base effects no longer exist, and now, of course, we've got the move in energy markets. And while there's optimism around, I agree. The Wall Street Journal article seems to suggest the Fed is very close, and the market's going to latch onto anything that speaks to peak Fed type narrative. There are those economists out there who expect to see a decent rise in the headline inflation rate on Wednesday, and that the core rate might come a little bit lower, but not low enough, certainly, to get the Fed thinking that the job is done. So I think we're a long way from having a green light for an all clear just yet, I suspect.
Yeah, even with that said, we did hear from Treasury Secretary Janet Yellen over the weekend saying that she feels pretty good about the chances for an economic soft landing, not necessarily hurling the mission accomplished banner, but at a time when there are concerns about reacceleration of inflation. I wonder what you made of those comments.
Yeah, no, I think it's, one, you'd expect the Treasury Secretary to cheerlead the US economy. That's only right and proper, but shouldn't really be new news in itself, I'd argue. And secondly, yes, I think it's fair to say that the momentum is with the soft landing camp, and has been, if you look at the data releases we've had for a couple of months now. But the nagging fear, which hasn't gone away, is that while we might be close to peak Fed, that doesn't necessarily mean that the Fed's version of higher for longer has gone away. Now, the issue at the moment is that the equity market is defining higher for longer as 6 months, or give or take. And that's because in past cycles, once we've hit the top, you tend to see a move lower in rates pretty quickly. But the Fed are saying that they're not going to move quite as quickly this time because they're worried about core inflation, services inflation, housing inflation. So you've really got to watch those numbers. And I think despite what the Wall Street Journal is saying, it's not yet clear that we are definitively going to get progress down towards the 2% target.
Hugh, do you think enough has been done from the Fed's perspective in order to eventually get to that 2% target, or do you think potentially more hikes could be necessary?
Yeah, that's the million-dollar question. I mean, this cycle has been so different already with COVID and lockdowns and the leads and the lags, but surely the most striking feature of all has been how interest rate sensitive sectors, housing being the best example. 500 basis points of tightening and housing not rolling over is quite amazing. Now, I think we all know the narratives that go around that, whether it's fiscal stimulus, whether it's lack of supply and people locked into good mortgages, just not looking to move. The Airbnb story might be interesting on that front in terms of whether it frees up any supply. But yeah, that is the million-dollar question. And I think that's it's not one that you can easily answer. It's going to be a question of watching the data as it emerges over the months ahead. And I think, to be fair to the Fed, that's why they're stressing data dependency so much.